For this chapter, I am going to discuss the necessary background for understanding different securities markets around the world and the changes that are occurring. For the first part, I am going to discuss the general concept of a market and its function. Then, I will discuss the characteristics of a good market. Organization and functioning of securities markets, Part 1. What is a market? The term market can be defined in several ways. It is considered as the means through which buyers and sellers are brought together to aid in the transfer of goods and or services. It can also be defined as a place where two parties can gather to facilitate the exchange of goods and services. The parties involved are usually buyers and sellers. Technically speaking, a market is any place where two or more parties can meet to engage in an economic transaction, even those that don't involve legal tender. In this subject, we refer to the market as the financial market. And the financial market is defined as a market where buyers and sellers trade commodities, financial securities, foreign exchange, and other freely exchangeable items and derivatives of value at low transaction costs and at prices that are determined by market forces. The following are the things that we should not forget about the market. First, the market need not have a physical location. Yes, it does not need a physical location. It is only necessary that the buyers and sellers can communicate regarding the relevant aspects of the transaction. With advancement of technology, there are many ways that buyers and sellers can communicate. There are countless ways of how we can transact using the different platforms provided to us. Second, the market does not necessarily own the goods and services involved. For a good market, ownership is not involved. The important criterion is the smooth, cheap transfer of goods and services. In most financial markets, those who establish and administer the market do not own the assets, but simply provide a physical location or an electronic system that allows potential buyers and sellers to interact. They help the market function by providing information and facilities to aid in the transfer of ownership. Such is the case for our stock exchanges. Third, a market can deal in any variety of goods and services. For any commodity or service with a diverse clientele, a market should evolve to aid in the transfer of that commodity or service. Both buyers and sellers will benefit from the existence of a smooth functioning market. Take note that a smooth functioning market can benefit all the people involved in the transaction. In the following slides, I am going to discuss each and every characteristic of a good market. Well-functioning financial markets are important factors in the transmission of monetary policy to the economy, as well as a key foundation for long-term economic growth and stability. Developed capital markets have sometimes been analogized to the engine of a growing economy. They are good at mobilizing, directing, and allocating local and international savings. To be effective, however, capital markets must try and ensure that investors get the best returns, given their specific risk appetites, and that competitive businesses can readily access finance and respond to opportunities. That is to say, they must offer a menu of risk-return options that is both suitable and useful to various types of investors and investments. Timely and accurate information. Prospective investors enter a market to buy or sell a good or service quickly at a price justified by the prevailing supply and demand. To determine the appropriate price, participants must have timely and accurate information on the volume and prices of past transactions, and on all currently outstanding bid and offers. Accurate, reliable, and timely information is vital to effective decision making in almost every aspect of business. The availability of timely and accurate information benefits the investors. Timely and accurate information help investors make good decisions. The availability of historical as well as present data and information is important for investors to strategize so as to achieve their financial goals. According to the Philippine Stock Exchange, one of the rights of the investors is to have full access to accurate and timely information. Every investor should be given complete, accurate, and timely information to allow them to make informed decisions about their investments. Another important characteristic is liquidity, the ability to buy or sell an asset quickly and at a known price. That is, a price not substantially different from the prices from previous transactions, assuming that there are no new information available. An asset's likelihood of being sold quickly, sometimes referred to as its marketability, is important, but it is not sufficient condition for liquidity. The expected price should also be fairly certain, based on the recent history of transaction prices and current bid-ask quotes. While not always easy to define and measure, liquidity is typically understood as the market's ability to absorb large amount of trades without causing excessive price movements. In addition, liquid markets are characterized by narrow bid and ask spreads. This means the transactions are carried out in a cost-effective manner. Liquidity in secondary markets determine the success of public offerings, reduces the cost and risk for underwriters and market makers. It also reduces the cost for investors via ensuring lower volatility and transaction costs. Thus, from a macro perspective, liquid capital markets are essential for the efficient allocation of capital, which results in lower cost of capital for issuers. At the micro level, a liquid market ensures access to a diverse range of investors with various trading strategies. Traditional measures of market liquidity include trade volume, market turnover, bid-ask spreads, and trading velocity. Moreover, liquidity also depends on many macroeconomic and market fundamentals. This include a country's fiscal policy, exchange rate regime, as well as the overall regulatory environment. Market sentiment and investor confidence are also key to improving liquidity conditions. Market liquidity, an important factor that affects market efficiency, is primarily determined by the effectiveness and efficiency of the market's price discovery function. For instance, the uncertainty as to the execution price is low for liquid markets. This does not necessarily imply that the execution price is identical to the mid price of the bid-ask spread, but rather that the deviation between the two should be predictable and minimal. In practice, this is likely to be associated with low and stable bid-ask spreads. Thus, there really is a need for timely and accurate information. A component of liquidity is price continuity, which means that prices do not change much from one transaction to the next unless substantial new information becomes available. For example, no new information is forthcoming and the last transaction was at a price of 10 pesos. If the next trade were at 10 pesos and 10 centavos, the market would be considered reasonably continuous. A continuous market without large price changes between trades is a characteristic of a liquid market. A market with price continuity requires depth. which means that numerous potential buyers and sellers must be willing to trade at prices above and below the current market price. These buyers and sellers enter the market in response to changes in supply and demand, or both, and thereby prevent drastic price changes. In summary, liquidity requires marketability and price continuity, which in turn requires depth. The next characteristic is low transaction costs. Lower costs, as a percent of the value of the trade, include the cost of reaching the market, the actual brokerage costs, and the cost of transferring the asset, make for a more efficient market. This attribute is often referred to as internal efficiency. What does it mean to say that a market possesses internal efficiency or is internally efficient? A well-organized, real-world securities market should not only establish price levels that are right, in the sense that they fully reflect available information, but also should provide the types of transaction services buyers and sellers desire at prices as low as possible given the costs of providing these services. In other words, such a market should accommodate the temporary excess supply and demand conditions that arise when underlying demand and supply are stable. For instance, even with a stable set of available information. Accommodation is provided by market makers or dealers who stand ready to trade with investors desiring immediate transactions. They perform the function of smoothing out temporary imbalances in the flow of orders by trading for their own accounts, earning for themselves a jobber's turn on the spread between the bid and ask price, a turn comparable to that earned by retailers in the markets for goods and services. The high transaction cost involved in trading is usually what discourages many investors because investors want to generate income from their excess funds. They wouldn't want to invest it in securities that would require higher transaction costs. Another characteristic of a good market is rapid adjustment of prices to new information. A buyer or seller wants the prevailing market price to adequately reflect all the information available regarding supply and demand factors in the market. Participants want prices to adjust quickly to new information regarding supply or demand, which means that prices reflect all available information about the asset. This attribute is referred to as external efficiency or informational efficiency. What is meant by external efficiency? What does it mean to say that a securities market is efficient? One widely accepted notion is that efficient means that new information is widely, quickly, and cheaply available to investors, that this information includes what is knowable and relevant for judging securities, and that it is rapidly reflected in security prices. Fama argued that a market in which prices always fully reflect available information is called efficient, because this basic notion of efficiency implies that a market's equilibrium conditions are such that trading decisions based solely on existing information do not yield expected returns in excess of expected equilibrium returns. It is sometimes referred to as fair game efficiency. Fair game efficiency. A market in which prices fully reflect available information is necessarily a fair game only in the sense that those who are outside the market making process are faced with a common set of rules and cannot expect to outperform each other by trading solely on existing information. The rules themselves, however, being a product of the way the market is organized, can be most unfair. To the extent that they are, it is something of a misnomer to suggest that the overall game is fair. End of part 1.